Depp on here. It's been a while since I've been in the hot seat for the briefing, so good to see everyone. So what I thought I'd do today, actually, is just something a little bit different. In a second, I thought I'd just have a look at the daily. All I've got here are daily charts on the screenshot, cleaned up. Hopefully Ant's not going to be too annoyed. I've just deleted all of his technical analysis. And we're going to start again. So I thought I would just, in today's briefing, just look at the sort of more medium term and look at the technical situation, and I'll come on and draw some lines on here shortly. But let's just kind of get through some of the stuff that's been happening from yesterday and overnight on the kind of macro side. And definitely chart of the week. You ready for this? I'm going to transition my screenshot for chart of the week. And here it is. This is straight out of the Norwegian Stats Office. And yep, that is right. It is official. This reveals that 30,800 moose were shot in the 2016-17 season. That's down 300 from the previous year. You've got a serious downside on moose hunting, people. So this is out of the Norwegian's official stats office. The equivalent here in the UK would be producing inflation numbers and all this kind of stuff, but the Norwegians focusing on the moose hunting season. However, good news for mooses. However, bad news for deer. Red deer. Number of red deer shot on the up, almost new all-time high. So this is official economic data at the Norwegian Stats Office this morning, just to keep us on our toes. But if we look at the data calendar, then for the rest of us, really, it doesn't look very interesting until we kind of get into the afternoon, I'm afraid. So we've got virtually nothing of interest from Europe at all. We've got a couple of bits of data of note from this afternoon with, again, these are all slightly earlier because of the time difference. So you've got 1:15 industrial production data. One thing of interest here on the year-on-year print for industrial production, we're expecting 0. The reason why that is of note, I don't know, when was the last time you looked at an industrial production annualized chart for the US? Well, if you have, then you'll know that last month was very notable. Well, actually, sorry, it wasn't last month, it was the month before, wasn't it, where we actually finally made it into positive territory, however, dropped straight back to 0. Now, we're expecting another 0 print here today for the month of February. I mean, this is quite shocking, this chart. If you go to a 5-year time frame, then it kind of puts it in a slightly better picture. But, we saw a nosedive end of 2014. Actually, a lot of this seems to be very nicely correlated with the commodity price movement, with the collapse in commodity prices end of 2014 into 2015, and then the subsequent recovery we've had back end of last year. But we want to see this stay above 0, just to confirm that at least this sort of upward trend that we've got going here is still alive. So that's industrial production. The other number to look out for today is on the consumer sentiment side. So University of Michigan will be delivering their preliminary number for March. So this is the important one. Remember, with this data you get 2 readings a month. One in the middle of the month called the preliminary reading, and then one at the end of the month, which is the final one. It's normally the mid-month one that perhaps can lead to some market reaction. It's the one that's we're less certain about, and we're expecting 96. If we just check out this chart, had a very punchy couple of readings December and January, and then a drop back in February, and we're looking for 96, which in its own right is a very strong number. If you look back over 10 years, then 96 is basically as good as it gets. Those numbers we got January and December were, I mean, let me go to maximum here. They were the best readings we'd had since 2004, and that was only a brief blip. It was basically the best readings of the century, if you can believe that. So consumer sentiment is still very, very strong when you're looking at the kind of long-term averages in the US. So yeah, unfortunately that's it on the data front. So quite a quiet day. One thing to note though, certainly, is that the G20 finance ministers meet, and that begins today. Okay, so that'll be a 2-day meeting, I believe. So that's something to look out for. We'll probably get news flow on that tonight and sort of over the weekend. All right, so yeah, as data calendars go today, not particularly interesting. What we do have is we've got a bit of upside. I'll show you the euro chart in a minute, but you can have a look on yours. But the euro's certainly been punching higher, and that's because we've had, let me just get the screenshot. We've had this guy called Nowotny from the ECB, and Nowotny's this guy here. This is the ECB. This is quite a decent chart looking at not only doves to hawks scale. If you're looking on the x-axis here, the more to the right, the more hawkish. But then also looking at the size of the economy that you represent in terms of share of the euro area GDP. Okay, so I forget about these guys at the top. They're at the top because they're the executive board. They're not representing any individual economy. Even though Draghi's Italian, he does not represent Italy. So Nowotny sits here. Just to get it in perspective, where is he on the dove-hawk scale? He's on the hawkish side of neutral. You know, he's certainly no Weidmann, for example, who's the uber hawk. And he represents Austria, so he's Austria's head of the Austrian Central Bank, and so he's decent sized, let's say, on the kind of GDP scale. So Nowotny's made some comments overnight, and he's basically said that we're not necessarily going to follow the US's model when it comes to the exit strategy, because what the US did, of course, is they finished their quantitative easing program in October 2014. Then they didn't start, so that's where they tapered QE to zero. Okay, October 2014. They then started raising interest rates December 2015. Hike number 2, December 2016. Hike number 3, March 2017. Okay, so the Fed finished QE, then started raising rates. What Nowotny said yesterday was, we don't necessarily have to do that. And what he said was, we can actually start raising interest rates before we've finished quantitative easing. So if we just flick back to the charts and we'll just quickly focus on, let's say, the euro to start with. I mean, it's certainly been a good week. This is a daily chart looking back over the last few months, and it's certainly been a strong week. Obviously, dollar weakness Wednesday evening, and just added to the upside yesterday thanks to Nowotny, basically. And just be aware of this key top, the 2017 high set on the 2nd of February. It's at 108.44 on the futures. This is continuation chart, and just be aware of the little price point above that, which is the December 2016 high. And if I make this chart a little bit bigger, then you'll see that since we kind of broke lower, since the election, since Trump won the election, that's where we got this dollar strength theme kicking in. We made new lows for 2016. Since that, we've been in a consolidation range, as you can see, and we're right up at the top end of this. This is important territory up here, technically. 108.44, 108.78, because look, that was the October low as well, 108.78 on the futures continuation chart. Very, very important price points here. So we've got to be mindful of that today. I mean, we're certainly in range of both of these prices, both of these levels today, and maybe then next week as well. We need to be mindful of these key price points. But Nowotny has just maybe thrown into the ring, or this isn't the first time an ECB guy has said this, but Nowotny's a bit more neutral, and so the fact he's said it is interesting. If we just flick back and look at the economists and what they think, and so this is a chart looking at when will the ECB raise the deposit rate and when will they raise the benchmark rate, and you've got so you've got people so economists are expecting the ECB to revise the rate guidance by the end of this year, then start perhaps raising the deposit rate. That's the rate that's in negative territory at minus 0.4%. They reckon they might start raising that Q1 next year, and then they're not going to start to really raise the proper benchmark rate until Q2 maybe. But this, of course, means that the ECB, well, this is on the assumption the ECB have ended their QE program by then, but that I can't see that happening. I mean, they've committed to QE till the end of this year, of course, and at the moment, people are expecting a tapering to perhaps begin in September.
Sterling outperformance.
We'll just get on to sterling in a minute. Just quickly, one more chart here. This is quantitative easing then. So when do economists think that the ECB might start making a move on QE? And here you can see that the general expectation is that tapering might begin in January 2018, with the change being announced. So that's when they announce they're going to start tapering. The thought is September is the most popular. So this is what economists think. September's meeting, they'll announce they're going to start tapering, and that tapering will begin start of 2018. All right. And if they use a US style, then they're going to have to finish QE, taper it to zero, then start raising rates. And this is what Nowotny said. He said they don't necessarily have to do that. They can start hiking before they end QE. So definitely a bit of upside on the euro, and just be aware of that technical long-term situation. I just heard the Squawk talking about cable, and indeed, we've definitely had a bit of obviously a punchy week. I mean, a lot of this is dollar weakness, of course, with the Fed. I don't know, somehow it's quite remarkable. I have to say, I think the Fed have pulled off. I've got more respect for the Fed since Wednesday than I did before Wednesday, because they've managed to hike rates in a dovish way. They've managed to hike in March and somehow spin it that it's a dovish hike, which is quite extraordinary. If you go back a few weeks, we weren't expecting them to hike at all, and now they've hiked, and it's genius because the dollar is back to where it was before they started communicating they were going to have a much earlier than expected hike. So cable right back to where we were on the back end of February, when the Fed hawkishness started to come in. Just go back to that euro chart. If you think about it from a euro perspective, the dollar's weaker, a lot weaker than it was, when the Fed started their kind of hawkish rhetoric. So you got to hand it to them. I think Yellen's finally worked out how to control markets the way she wants. I think it's taken her quite a long time to get that right in the kind of shadow of Bernanke, but I do think actually Yellen's now in charge properly of financial markets, and these markets are telling me that. Look, cable on the upside then, testing the 124 handle on the futures. You can see though, cable's a long way off the price points we're seeing on the euro. The euro is not far off the high of the year. The high of the year for cables right up at 127.15. Obviously, you've got a lot of Brexit-related issues in the mix on this pair that you don't, obviously, on the euro-dollar pair. So we've had a lot of sterling bullishness through January as Theresa May brought in the parliamentary system. That's when we started to get announcements that Parliament are going to have to vote on triggering Article 50 and so on. So this move this week, back end of this week then, dollar weakness mainly, obviously Forbes yesterday from the Bank of England dissenting and wanting to hike rates. Obviously that helped with yesterday's move higher. So a bit of dollar weakness and sterling strength here, back to the 124 handle. But do bear in mind, actually, this is pretty much bang on the middle of the range for 2017, 124. You can see it was quite key, a little bit messy, but key support through February. Big break as the Fed started to get hawkish end of Feb. And then we're back to that point now. So bang in the middle of the medium-term range, but 124, an important price. So that's looking at the FX space. So let's have a look elsewhere. Let's look at equities. And let's look at US equities, because we are still right up here. It's been a couple of weeks since we set a high when we hit the 124 handle back on the 1st of March. We've kind of been sideways. It's hard to know where we go from here, to be quite honest. I think we still need to. I think the Fed have, again, somehow hiked rates a lot earlier than expected, and still the S&P manages to hang on to gains. So this is another clear win for Yellen, I would say. Early rate hike and not damaging equity sentiment. You've got to respect that. And so, I think we're moving into the end of the quarter, don't forget. So March we'll wrap up quarter one, and then we're going to start to get some GDP prints. And this is where I think there's quite a lot of divergence. US GDP, some of the GDP trackers that we watch, there's one that the Atlanta Fed have, and then there's one the New York Fed have. Both are quite well respected. It's just that I don't know if you realise, but at the moment these two GDP trackers are miles apart. Atlanta Fed think that the US economy will grow at just 0.9% in quarter one, whereas the New York Fed reckons 3.1%. So one of those is really low and the other one's really high, and obviously both can't be right. So I think it'd be quite interesting, once we've got through the sort of first 100 days, let's say, of Trump's presidency, and we start getting GDP prints for quarter one, we get earnings reports coming through, we'll really start to get a handle on what's what with Trump. And as we move further into the year, obviously we're going to start to get more evidence on what he intends to do on the fiscal side. He did release his budget yesterday, where he's looking to slash costs in certain parts of the government in order to raise or release some budget and push it towards the military side, but that's actually expected to get actually rejected by Congress, is the thought. Even though we've got a Republican Congress, they're still expected to reject mainly most of this idea. So, and we're still waiting to hear. As time goes by, it does seem like, from Trump's point of view, the tax cuts are probably going to come later than we'd thought, and maybe they're going to be smaller. We'll have to see. But still, currently the S&P's up here. I've got a chart which might display, let me transition this. This is a chart looking at number one, the S&P. So if you look at the blue line, that's the S&P 500 marching higher. This is a 12-month chart. And then the white line is the CBOE's fear gauge, the VIX. And this is remaining, obviously, incredibly low, below 12, right down at pretty much record lows. And so you've definitely still got this period of, calm, and certainly reflected in the white line, the VIX showing calm, showing fear levels very low, and it's just a question of, can that last? We'll have to see. I mean, it looks like it can for now. I mean, it looks like the S&P's pretty comfortable up here, and we've gone through the Dutch elections. That's the first kind of political mainland Europe political risk event has gone. That was the smallest risk event, but and if we look at the timeline going forwards, what happens now, because this week was really important when you think about the Fed meeting, and we've had the Bank of England, and we've had a lot of important data points this week, and indeed the back end of last week with the US labour market report that went through fine, strong on the job creation side, a bit weak on wages. We've got through the Brexit bill situation, and Theresa's finger is on the trigger, and the Fed have hiked, and we've got through all of that without seemingly any kind of panic. Trump's delivered a bit of his budget, that's kind of gone now, and so really you're looking on the calendar, and we've got a bit of open space now. We've got a month and more before we get to the first round of the French elections, which will be on the 23rd of April. So it looks like we got through quarter one's risk points without anything major happening in terms of episodes of panic. So let's just get back to the charts here. Obviously, one big, just walking through the asset classes. What I will say, even though the S&P's been flat for the last couple of weeks, do bear in mind the DAX yesterday punched through that high that we had start of March. So new high for the year, very briefly up through the 12,100 handle. We're sat back below that now. So just from a candlestick point of view, that's quite an interesting candle there. especially when you bring in that reference point of the 1st of March high that was the high of the year. That's where we opened, strong move higher, but by the time we got to the end of the session, we'd broken back below and we closed below that key technical price point. We got a red candle, bit of a shooting star, reversal signal here perhaps. We'll see how we get on today, but it might be a bit of a quieter day. This might be a story for next week. Can the DAX, is this a reversal signal? Are we going to see 12,100 as the high point for quarter one and a drift back lower as we get into the end of the month? We shall see, obviously. Right, just thinking about two more things. Oil, obviously probably the market of the month, you would probably say, with regards to movement. And we've been in a messy consolidation this week. It's been tricky to kind of, once you've had a big sell-off like this, big breakout, it's then hard when you're in that consolidation period. It's really tough to kind of judge direction. And at the moment, there doesn't seem to be any. We're kind of tracking below $50, obviously. So 50 is an important price, which we haven't encountered yet since the break lower. We seem to have defined a bottom of the consolidation zone around about $47. So these are the kind of prices to be thinking about, and we're right in the middle of that now. So it's just tough to judge direction here. So I'd say be a little bit careful with crude oil for the time being, as we're in this kind of messy consolidation zone. And then we obviously just need to see just how much these shale producers can carry on ramping production higher. Obviously the Saudis, bit of confusing chat on the Saudis earlier in the week. Firstly, they're hiking production, and then they're saying, hang on, no, we're committed to production cuts, and it's a bit of a mess. So, yeah, be careful on crude today. Bang in the middle of the consolidation zone. Really tough to judge. Is crude going to go higher or lower today? I honestly have no idea, to be quite frank. And so just be mindful of that. Finally, then, I'm going to finish on T-notes and just bonds generally. Very interesting week, to say the least. Again, somehow the Fed pulled off a dovish hike. I don't know how, but they did. So prices rising, obviously on Wednesday, big move high. In fact, this was the biggest up move for T-notes, I think, since, of the year, I think it was. Tracked back, gave back about half of that, just under half of it yesterday. Let me show you on the yield front, because we always look at T-notes here on the chart thinking about price. Let me show you on the yield side. This is a chart of US 10-year yields, and 2.6% is very important, and this was the high point we had middle of December last year as we moved into that Fed rate hike. And we started to see the Fed communicate to us that they're going to intend to hike rates 3 times in 2017 rather than the 2 times that we had thought at the beginning of that month. And obviously Trump winning the election. This was the Trumpflation move. This was Trumpflation, and it was Fed three hikes 2017 move. Since then, that 2.6% yield has been the top. And this has been very strongly tested as we've gone through the end of last week, and it's just, again, somehow the Fed have pulled this away. They've hiked, and yet we've had yields drop. Same thing on the short end. And it looks like for now the Fed have managed to defend this 2.6 yield resistance. And so this is something to really look out for as we go through or into the end of March. Our T-notes, is this range confirmed and we're going to track back lower? Or is it the case that the Fed have only temporarily put the brakes on this yield climb, and we're going to see 2.6 get broken as we go into the end of March? We'll have to see, but this is an important yield point to be aware of. Okay, I think that's pretty much all I wanted to cover. Just finish on these charts, just in terms of today then, final day of what's been a really busy week. I'd say perhaps chances for much movement today. I'd say it's going to be a quieter session. Be mindful of that. I think we've got some euro strength, and keep your eye on those key price points that I mentioned. Thinking about that high from earlier in the year, and then the high from December. Cables again trying to get up through the 124 handle, and equities pretty flat at this point. All right, that's it for the briefing. Data wise, remember trade balance from the EU at 10 o'clock, but it's that 1:15 industrial production, and it's the 2 p.m. University of Michigan numbers to look out for. Okay, enjoy the final session of the week. Thanks a lot.